Yeah, hi, I'm Luke Alexander, President and CEO of Newcore Gold. Newcore Gold is advancing the Enchi project in Ghana. It's a district scale exploration project that's fundamentally underpinned by very robust economics that were put out in a 2021 PEA. We're in the process of updating that PEA, and I'd say now is a great time to be looking at Newcore Gold. Trades on the TSXV under the ticker NCAU and on the OTCQX NCAUF. We're currently trading at about $8 per ounce in the ground, less than 0.1 times the NPV of the project. And we've obviously been caught up with a number of other gold companies in 2023 with the sell-off that we've seen. Management owned 20% of Newcore Gold. We've invested alongside investors. We continue to invest alongside investors because we see the tremendous value opportunity that there is within the company. We're 45% institutionally owned, and these are deep-pocketed long-term investors who also recognize the district scale exploration upside that we hold, as well as the fundamental underpinning of value that there is within the company.
Look, good to see you again. Been a while. So appreciate you coming on. Yeah, like I say, you've been caught up with lots of fresh metal companies in what's been happening over the last 3 years, and your share prices, I guess, no different from most in that space. Been a nice sort of glide down to where you sit today. I'm interested in how you take what you've got today and create value for that, whether you do it or whether you need some other kind of mechanism, change the plan at all. So remind us of the robust PEA you're talking about that you're about to update.
Yeah, so in 2021, we put out a PEA on the project. Since then, in March of this year, we put out an updated resource. That updated resource grew the overall size of the resource, but it also really de-risked the ounces in the ground. We moved 740,000 ounces from the inferred category into the indicated category, which obviously gives more confidence in those ounces, as well as we have another 970,000 ounces of inferred on top of that. So we're going to wrap an updated PEA around that, get it out in the first half of next year. If we look back at the PEA we put out in 2021, if we look at it at an $1,850 gold price, you're looking at an after-tax NPV of US $300 million, after-tax IRR of 54%, less than a 2-year payback, and a nice production profile of over 90,000 ounces per year. So we've looked at the larger resource that we now have on the project, and we think that we're going to be able to put out an even better, more robust PEA in the first half of next year. That's been significantly de-risked with a number of things that we've accomplished over the last couple of years.
Okay, well, why an updated PEA? Why not run straight into the PFS? PFS gives people more confidence. I suspect it might be a genuinely robust economic study. So what was the thinking there?
One of the big things you need to take a PEA to a PFS is infill drilling. Obviously, infill drilling can be expensive. So a lot of the work that we've done and that you'll see within the PEA that we put out in the first half of next year is at a PFS level. The met work, for example, which I'm sure is something you're going to ask about, we've done a huge amount of met work on the project over the last couple of years, and that's starting to get to a PFS, FS type level. We've done, environmental and social baseline studies. We're in the process of doing a bunch of hydrological test work on the project. So these are all things that ultimately are beyond what's required for a PEA. And our goal as a company who's looking at taking this to a production decision and then funding the building of the project, we want things to be done to the highest standard. So we're doing things beyond what's required for a PEA, but obviously there's a cost associated with infill drilling that on the back of the PEA, we'll speak with our major investors and see if it makes sense to push it towards that PFS, or at that point, whether we continue to drill.
Okay, because I've been looking, obviously, at the press releases across the year. We spoke to you at the beginning of the year, and it's been a sort of quiet year. I guess you've been mindful of cash and allocation of cash, and what's the best return on that investment of that cash. Um, drilling results don't seem to really have kind of got anyone too excited at the moment. So why is the revised PEA the best use of capital? Why not bother with that? Preserve your cash and kind of get through the kind of other kind of more robust kind of PFS type activity next year when hopefully the market recovers. I mean, what were the discussions?
Yeah, so I guess 2023 we have accomplished a lot, and yes, I hear your point that it hasn't been as busy as years gone by. But we have put out an updated resource. We've put out a number of met test results. We also put out some very nice high-grade drill results on our NIAM deposit on the back of the first ever underground resource that we put out as part of that resource update. So we have been active in terms of pushing the project forward. Our view is that if you look at the economics of the project today, this is a very economic project that can be built for relatively low capex. We're looking at $100 million of capex for roughly 100,000 ounces per year for an after-tax NPV of $300 million with district scale exploration upside. So when we looked at it, we said this is something, and the feedback from the market, from our investors, is that they want to see this project move towards that construction decision. So this is one of the steps along the way to de-risking the project and highlighting, the economics that the project has. So that's where we decided, in this market where nobody's being rewarded for exploration results, we can really de-risk the project for relatively low capital. I mean, updating a PEA, met work, environmental social baseline studies. These things don't cost a huge amount of money, but they're very important from a de-risking perspective. And there's kind of two elements there. There's the market side of things and investors looking to buy the stock, but then there's also the corporate investor. And anytime you start thinking about the corporate investor, when they look at projects, they want to see those projects de-risked all the way through. They want to have 100% confidence in the met. They want to have all the studies done on the project. They want it to be at a stage where you can ultimately just come in and build the project without having to do all the work that leads up to that construction decision.
Right, and it's kind of like I'm enjoying having this conversation because what we've seen some companies having to do, or some companies deciding to do this year, is change the plan somewhat in a reaction to what's been a very difficult market in terms of not only the equities, but access to capital, access to cheap capital, and any interest whatsoever in gold, it seems. So for you guys, I know you said your shareholders saying, and 45% institutional, I think you mentioned, of course they want you to get through production. That's the name of the game. It's not pump the market. It's produce gold, produce cash. But at this level, were there discussions about perhaps changing the scale of the operation? Maybe it might reduce the efficiency and the economics initially, but it feels like a safer bet, wouldn't it? Just kind of start small and ramp up.
Well, so Matt, I guess one of the advantages we've got at Newcore is we've actually got a project we can build, and the economics speak for themselves from that perspective. So we don't need to be out there drilling. If you look at a lot of companies, if you're not drilling, you're basically a zero, because you might be sitting at a resource size that doesn't justify a project. Your project might be in a jurisdiction or a part of the world that it requires a huge amount of capex to put that project into production. So you need to get to call it 3 to 5 million ounces. We've got a very buildable project that for, again, $100 million can be put into production. When you look at that $100 million, let's say you look at 60% debt or 50% debt, you're looking at a $40 to $50 million equity position to put that into production. That's the kind of size of project that we can manage and that we can put into production. So again, that's why it's so attractive to move it towards a PEA, a PFS, and then ultimately a construction decision. So you start talking about going smaller. I mean, we've looked at at some of the economics of, let's say putting 50,000 ounces into production. Once you're at that kind of size and scale, it becomes more difficult. You're trading dollars to a certain extent, as well as the economies of scale is one of the things that we looked at. And the benefit of every additional 10,000 ounces really adds to the economies of scale and ultimately adds to the economics of the project. So we've done a lot of work internally looking at different size projects, and that's why we're kind of targeting this size project, as well as you kind of mentioned, 45% institutionally owned. I mean, these are deep pocketed long-term investors who, as we de-risk the project towards that construction decision, they've got the ability to ultimately help fund us into production. So that's why we're taking the approach we are.
Okay, but I understand that. Now I understand the efficiencies of scale, and that's why I said, do you forego some of those efficiencies in the early years just to get the thing over the line? So, but let me focus on that. How you get this funded and what type of money. You talk about maybe 40% equity on 100 million capex, and I don't know what the opex is or any other additional cost maybe involved. At a $20 million market cap, $40 million bucks, that's a chunk of change. Is Franklin or Ruffer or Merck or CQS going to step in? It doesn't seem like they're back. I mean, how do you get this funded? Because if you can say to the market, I'm very confident about the way that this gets funded without diluting the heck out of our current shareholders on an equity basis, and the debt terms aren't so onerous that we can't refinance them out, get confidently at some later date. I'm all ears, because 100,000 ounces a year, love it.
If you look at companies that move through the kind of development path line, let's call it, so taking it from PEA to PFS to FS and into a construction decision, I mean, we're trading at about 0.05 times the NPV of the project, so less than 0.1 times the NPV of the project. If you look at a number of development stage projects and where they're trading from a multiple perspective, as they get to that feasibility stage, the company ultimately re-rates along that path. So, if you look at a feasibility stage project that, has good economics, is in a good jurisdiction, like Ghana, you could see those trading at maybe 0.4 to 0.5 times the NPV of the project. So, you look at where we are today, and, there's multiples from where we're trading today to where, we should be trading at a pre-construction stage. So that's the opportunity, is that you re-rate all the way through that path. So as we go from PEA to PFS to construction decision, you see that re-rate happen. And now you're all of a sudden, potentially raising construction capital at $100 million valuation, let's say. So then the dilution isn't as punitive, obviously. And the advantage we've got, all the way through that is, if the market comes back and exploration is in favor again, we've got a district scale exploration project that we've still only scratched the surface. I mean, we've only drilled down to a maximum depth of 300 meters, and that's on a handful of holes. Our pit constrained resource today sits within pits that average 80 meters. So really a lot of the focus has been on that oxide transitional kind of material that sits on our project. That's obviously the material that feeds the heap leach that we've outlined in the 2021 PEA, and that we're updating in the first half of next year. So there's still that huge district scale exploration opportunity. And what we will ultimately create is a self-funded district scale exploration company that uses the cash flow from the 100,000 ounces to aggressively drill out the rest of the project over time. And that's something that our institutional investors are really attracted to.
Right. I understand the blue sky, and that's, people get excited about that, subject to you being able to finance getting after it when you get into production. And I understand the theory of how you go through the economic phases to that point. I guess what the non-institutional shareholders that hold your stock are asking is, how do you do the next phase? How do you fund the next phase to allow you to potentially re-rate? God knows what the market's going to do next year. We think it's going to be positive, but we also thought that in 2023. How do you fund the next phase of the PEA update, then fund the PFS process to deliver a PFS, to hopefully deliver a re-rate? And there's no guarantees you're going to get a re-rate, because we've seen so many companies go through these phases and the market just doesn't care. So you've got to believe, what have I got to believe about your ability to kind of move through those phases? The next steps, not the future blue sky stuff, not even production, but what do I need to believe that you're capable of delivering for me as a shareholder that's going to get me excited about the leverage that this company potentially has?
Well, one of the advantages is we're funded today. So again, I'm sure, Matt, when you're
for what?
We're funded for the PEA and for the next 12 to 18 months. So when you look at the landscape today, and I'm sure, Matt, you've gone through a huge number of the companies out there who are currently trading on fumes. So when I talk to investors and the market, they go, "Wow, you guys have $5 million in the bank. You're in a very enviable position." So we're fully funded.
Let me just interrupt, Luke. Let me understand, because it's really important, okay? Because I could have $1 million in the bank and be funded for the next 18 months by doing sod all. So I want to say, you're funded to deliver the updated PEA, and then and next 12 to 18 months. What happens at the end of 18 months? What have you got? What can I say you can
so thanks, Matt. That's what I was just about to jump into. So that $5 million effectively funds the updating of the PEA, which will get out in the first half of next year. As you've seen, we've been putting lots of met test work out. We just completed 2 bulk samples. Those were 15-ton samples, almost 92% recovery from those bulk samples. That further validates all the met test work that we've done across the project to date. We're continuing to do additional met test work, environmental, social baseline studies, hydrological test work on the project. We're doing some condemnation drilling on the project, to ultimately make sure that where we're looking at putting the heap leach pad, doesn't have gold. So all of that work we are funded for. And, so we're very busy, active on the project, and a lot of that work doesn't cost a huge amount of money. So, from that perspective, we're well funded. Met test work, we can do that for relatively inexpensive. There's 2 world class labs in Ghana. The environmental social baseline study, I mean, that hasn't cost us a huge amount of money. And then obviously the PEA, yes, that costs money, but again, relative to our cash position, it's not a meaningful amount. So we're ticking all those boxes, getting all of that work done, which does create news flow, but more importantly, it fundamentally de-risks the project. So all of that work that I've been kind of talking about, over the last however long, 15, 20 minutes that we've been chatting, we're funded for all of that work, which, is kind of 12 to, and kind of a runway of 12 to 18 months, let's say.
Okay, so I suspect the 65% of your shareholders will understand what that means. So a PEA, which is quite easy to dismiss for many, because it's such a, it's what could happen as opposed to what, would happen or should happen and will happen, is the next economic study, the PFS, will require a bit more money to be able to complete, but you'll have done quite a lot of the things already needed for that. Is that right? Or will you be able to get that across the line as well within the 5 million?
Yeah, so we'll ultimately have a lot of the work done to a PFS level. And if you go look at the met work we've done, that's a great example where we're kind of already getting close to that type of level. The infill drilling is probably the most expensive piece of producing a PFS. So that's something that, when we look at it, probably somewhere around 10,000 meters, which is, $1 million to $2 million. But really, we want to make that kind of decision on the back of the updated PEA that we put out. Because at that stage, we can say, okay, well, this is the project we've outlined, 100 to 125,000 ounces of production over a 8 to 10 year mine life, whatever those numbers look like. And now we see that this is continues to be an extremely robust project that's been significantly further de-risked with all of those other components that we've been working on over the last couple of years. Now let's go infill, drill it, and take it to a PFS. So we kind of make those decisions as we go along, and we make those decisions in conjunction with the investors that we obviously have on our share register. Given they're deep-pocketed investors who obviously follow the sector very closely.
Okay. Well, look, I'm good. I just wanted to kind of maybe not dig you out, but dig into how this thing moves forward, and what I need to believe. So, one, for me, you've got the cash. You're not cash constrained like others. You are getting on with doing stuff on the ground, which will sort of, I guess, put you ahead in terms of when you do start a PFS process. And there's not too much infill drilling to actually happen. So, look, I appreciate the update. I think you're one of the stories we've looked at and go, not sure everyone gets it. No, not everyone understands where you're at or what the potential is. 100,000 ounce plus producer is not to be sniffed at. And for 20 million market cap at the moment, 14 cents, I think perhaps I'll set it for you. I think you're undervalued. So I appreciate you coming on. Stay in touch. We'll see you soon.
Yeah, thanks a lot, Matt.